Something unusual is unfolding around the US dollar. Something far bigger than most people realize. President Donald Trump's economic playbook is having a profound effect on America's currency. The dollar has already slipped nearly 10% this year, its sharpest drop since the early 1970s. At first glance, this seemed like the predictable result of several, let's say, unconventional moves Trump made during his first 6 months back in office. But as time has passed, the picture has become far more complicated. What looked like chaos may actually be part of a larger, intentional strategy. For decades, the US dollar has represented global trade, financial stability, and American power. Yet not everyone views this dominance as beneficial. While it helped the United States maintain its influence over the world economy, it may have quietly damaged parts of its own industrial base in ways people rarely acknowledge. And deliberately weakening the dollar would be an incredibly dangerous game. One small misstep could trigger a financial meltdown affecting not just the United States, but the entire global system. Yet despite this enormous risk, it appears the Trump administration is attempting exactly that, a controlled demolition of the dollar's supremacy, hoping it could spark one of the biggest economic resets in modern history. Whether this is a brilliant strategic gamble or a recipe for financial catastrophe is the question hanging over the world. To understand why this matters, you have to realize just how deeply the dollar is embedded into everyday American life. From the cost of groceries to your monthly mortgage payment, the currency influences nearly everything. That's largely because the dollar isn't just American money, it's the backbone of the world economy. More than half of global trade contracts are priced in dollars, and roughly 90% of all currency exchanges involve it in some way. And although it's easy to assume the US has always held this level of financial dominance, that's not true. The dollar's status was engineered over decades through careful political and economic policies, the very framework Trump's team now appears focused on challenging. After the Soviet Union collapsed, the US moved quickly to cement its place as the unrivaled global superpower. But across the Pacific, a silent revolution was underway. Nations like China, Singapore, and South Korea were exploding with growth. Cities that had been little more than ports or rural towns suddenly transformed into manufacturing hubs packed with skyscrapers, factories, highways, and neon skylines. Millions of people in these countries found themselves entering the middle class at unprecedented speeds. They bought new technology, better homes, nicer cars. But they also saved enormous amounts of money. The problem was their financial systems were still young. They lacked robust stock markets, stable banks, and large companies capable of absorbing all that capital. So their excess savings started pouring abroad, primarily into the United States. Over the span of a decade, hundreds of billions of Asian dollars flooded into American financial markets. This triggered a golden age. The US stock market quadrupled. Tech giants like Amazon, Google, and Apple emerged and reshaped the world economy. But beneath the surface, something else was happening. All that foreign money pushed the value of the dollar dramatically higher. By the end of the boom, the dollar had risen nearly 50%, one of the fastest increases ever recorded. At the time, this seemed like a huge win. A stronger dollar meant Americans could buy more with each buck they earned. Imported electronics, cars, toys, and home appliances became dramatically cheaper. Middle-class homes filled with foreign products, and for consumers, it felt like free wealth. But there was a catch, a massive one. A strong dollar made American goods far more expensive in global markets. US companies now struggled to sell their products abroad. And at the same time, cheap labor in countries like China, Mexico, and Vietnam created an irresistible opportunity for companies to move manufacturing overseas. With labor costs often just a fraction of American wages, domestic factories couldn't compete. The result was brutal. Across the country, Factories closed, towns hollowed out, and traditional industries faded. The U.S. lost roughly 3 million manufacturing jobs in a single decade. Industrial employment shrank to levels not seen in modern history. Yet the stock market kept soaring, propped up by global capital. Tech executives and investors grew richer than ever. Average incomes rose nearly 40%, but nearly half of that growth went to the richest 1%. Meanwhile, the bottom half of the country saw its share of national income collapse. Entire regions, Michigan, Ohio, Pennsylvania, were left behind by globalization. And for years, nobody in Washington seemed to care. Until 2016, when the political earthquake of Donald Trump's first election revealed how deep the divide had become. These struggling manufacturing states became his most loyal supporters. Trump's promise was clear: reverse globalization, rebuild American industry, and bring back jobs that had been lost for decades. His strategy centered on reshaping the world economy, breaking away from giant multinational trade systems and creating smaller, regional trading blocs centered around the United States. In 2018, he tried exactly that. His administration imposed 25% tariffs on imported steel and other goods. But the results were chaotic. Estimates showed that the trade war actually cost the U.S. around 170,000 manufacturing jobs. Manufacturing companies ended up paying roughly $46 billion in extra import costs. Far from reviving factories, the tariffs seemed to hurt the very industries they were meant to protect. Economists offered many explanations, but one theory quickly gained traction within Trump's inner circle. It came from Scott Bessent, an economist whose views would later shape Trump's second-term economic strategy. His argument was surprisingly simple. The tariffs weren't failing because globalization was too strong. They were failing because the dollar was too strong. Here's what happened. When Trump announced tariffs, global investors panicked. They feared that China and other exporters would be harmed by the new trade barriers. So where did they rush to put their money? Into the United States, the world's safe haven asset. This surge of foreign investment strengthened the dollar even more. And with an even stronger dollar, American manufacturers found it even tougher to compete globally. The tariffs were supposed to reduce dependence on foreign goods, but instead they made imported products even cheaper and domestic ones even more expensive. The conclusion in Trump's circle was blunt. If the U.S. wanted to revive its manufacturing base, it would have to break the dollar's dominance. The problem is, weakening the dollar on purpose is nearly impossible. The currency has decades of credibility behind it. Even when the United States caused the 2008 financial crisis, investors still fled to the dollar because they had nowhere safer to go. In the past, countries could devalue their currencies through capital controls, restrictions on foreign money, or aggressive monetary manipulation. But modern trade agreements have largely banned those tactics. But Trump has never been known for playing by conventional rules. His advisors realized that if they created enough economic uncertainty through massive deficit spending, unpredictable trade policy, and public pressure on the Federal Reserve, they might undermine global trust in the dollar. If that happened, investors could flee into assets like gold, the euro, or the Chinese yuan. The result would be a weaker dollar and a competitive boost for American exporters. This idea gradually evolved into what insiders called the Mar-a-Lago Accord, a strategic blueprint for quietly dismantling the dollar's supremacy. And over the past year, Trump's administration has taken actions that align almost perfectly with that plan. During his highly publicized Liberation Day press conference, Trump announced sweeping tariffs on dozens of countries, Germany, China, even tiny Cambodia, with some rates approaching 49%. Investors panicked. The Dow Jones fell nearly 8% in a single day. Treasury yields spiked. The dollar plunged to its lowest level in years as global markets scrambled to understand what was happening. Then, just weeks later, Trump abruptly reversed course.
Many of the tariffs he announced were quietly reduced or canceled altogether. Officially, the administration said it was responding to market concerns, but the damage was already done. Investor confidence in the dollar had been shaken. Nobody knew whether another wave of tariffs might appear at any moment. In the weeks that followed, the dollar kept falling, ultimately losing almost 12% against major global currencies. Gold demand surged to its highest point in a decade. And interestingly, several American export industries began showing surprising strength. Michigan's auto exports rose by nearly 12%. Texas saw energy shipments, oil, gas, and refined fuels jump by around 15%. Industrial states like Ohio and Pennsylvania began to report growth in steel and machinery exports.
Industrial states like Ohio and Pennsylvania began reporting growth in steel and machinery exports for the first time in years. But there's a dangerous flip side. When foreign investors pull money out of the United States, it doesn't just weaken the dollar, it starves the economy of capital. Less foreign money means higher interest rates. And for a government carrying more than $36 trillion in debt, higher rates are disastrous. Every single percentage point increase in borrowing costs adds roughly $360 billion to federal interest payments, which already consume nearly 15% of the national budget. Private companies are even more vulnerable. Tech firms, in particular, spent the last few years borrowing cheap money to make massive bets on artificial intelligence and automation. Roughly 92% of recent economic growth has been driven by AI-related investment. But if these companies suddenly face double or triple their usual interest payments, many could collapse. A wave of bankruptcies could trigger a deep recession. In short, America's entire post-Cold War prosperity has been built on the dollar's dominance. It allowed the country to borrow cheaply, run huge deficits, and attract endless foreign investment. Undermining the dollar might help revive parts of American manufacturing, but it also puts the entire financial system at risk. Whether Trump's team is executing a carefully planned strategy or simply improvising through chaos is unclear. But what is certain is this: the global economic order that has existed for nearly a century is shifting, and whatever comes next, prosperity or crisis, will affect the entire world for decades to come.